All right, welcome to the Hudson Board of Trade. It is November 13th. This trade is for ND1 again, and it's in CGC. And CGC does have earnings tomorrow, so it had a big run up. We capitalized on that last week. ND1 had a trade on for like 24 hours, made a great profit, and now his opinion has changed. He wants to do a synthetic short stock position in this stock. So we looked at it and we came up with a couple ideas, and I just want to explain them to you today. There's option one, currently at CGC it's trading $19. These trades are expiring on November 15th, which is 2 days away. All right, so we're just doing this quickly. So a -1 sloping is a short stock position. I'm going to draw a gap in this line. You guys are going to see this a lot, right? And we are most interested in buying the 17 put in November 15th, so for 2 days, okay? This is what we think is valuable. So we're going to finance that by selling this 21 call in November. Now I've created a -1 slope, right, that we can profit from if we're correct. So I don't like my students selling this call naked, right? So what I'm going to make them do is buy the 24.5 call, right? We have a +1 slope from the call that we bought. We have a -1 slope from the call that we sold. We can add those up. We get a 0 slope. 0 slopes have flat lines. So then we're just short a call spread. And beginners need to be short this call spread because we've got a risk-defined space here instead of unlimited risk like we would with a short stock position. Okay, so we can do this trade for 6 cents, just 6 cents a share, right? And our max loss is going to be the distance in this call spread, which is $3.50. 21 minus 24.5 is $3.50. So we have a $3.56 a share max risk. I suggested we do this 150 times to test this idea, okay? So 150 times $3.56 is our max risk. Now we have option number 2 over here too. It's the same thing, a -1 slope or a short stock position. But the difference is here, I'm gonna draw just a tiny gap in that line, okay? And what I'm gonna do here, it's the same thing. This is our long put position, okay? And we're financing that. I'm gonna just take this gap up with our short call graph, right? So this is a synthetic short stock position, right? And again, I don't like my students to just sell this call naked, right? So I'm gonna make him buy the 22 call. Right, and so we have a +1 slope from the call that we bought. We have a -1 slope from the 19 call that we sold, and we can add those slopes up. We get a 0 slope. 0 slopes have straight lines, so I'm going to take away my work here. And what we've done is we have a short call spread here with our long put. So we bought the 19 put. We sold the 19 call. That's a synthetic short stock position, okay? And we could do that for about 10 cents. But I'm making new students buy this 22 call in, and that cost us 20 cents, bringing the total cost of the trade to 30 cents. Now, this is the 19 line, and this is the 22 line. So 19 minus 22 is $3. So we have $3.30 per share risk, and we're going to do this trade 75 times. We're just testing out these 2 different ideas because the Hudson Board of Trade is like a laboratory where you can come up with your trading ideas. I've developed a way that we can test them and we can see which one is better. Now, this student also wanted me to go over delta hedging. This is a higher level concept, right? But let's choose this one, right? So right now, let's just say this thing has like a 20 delta. Delta is odds of being in the money is one definition for that, right? And let's say the card flips on Thursday. We were right, CGC is trading $9, right? So it lost about 50% of its value. Let's say $9.50. Okay, this 17 went from a 20 delta, right? The 17 put went from a 20 delta to now it's got 100 delta. That means if we did this trade 150 times, we can buy in 150 shares of CGC. Now, the reason why we have to know this is because a lot of times these earnings announcements happen when the option market is closed. But we want to lock in our profit. If we want to lock in our profit, we can turn around and buy shares of this stock. So we established this trade 150 times. It cost us 6 cents, right? Now CGC has earnings. Boom, it's trading $9.50. What do? Especially if you think it's at the bottom and it could rally from here. I'm going to go out and buy 150 shares of stock for $9.50. So I'm going to buy 150 shares for $9.50. If you think it's going to rally higher. If you're not sure if it's going to rally higher, maybe you buy 75 shares at $9.50 if you did this trade 150 times. But don't worry about it. This is a higher level concept called delta hedging, and we do this as an off the floor person just because the earnings number is going to come out, but the options market's closed, and if we want to lock in some profit, this is one way that we can do that instead of just selling out of the trade. But please, if you want to learn how to trade like this, or if you like these trading ideas and you want to learn more, please become a member of the Hudson Board of Trade. Subscribe to my YouTube channel, thumbs up my videos. Again, we watched Maria Bartiromo's Wall Street over the weekends, and she comes up with an earnings calendar, and I make just derivative trades that we can make based on that earnings calendar. So watch Wall Street with Maria Bartiromo, and then that will give you some trading ideas for the week that you'll be able to play with. So thanks for watching the video, and please become a member.